Analyzing transactions, debits and credits, T accounts, and journal entries. A chart of accounts is a listing of all accounts that are held in a ledger. The chart of accounts lists out the assets, liabilities, capital, drawing, revenues, and expenses in a certain order. Balance sheet accounts, which are listed first, are your assets. These are items that are owned by the company. They start with a number 1. Second, liabilities are listed. These are debts owed by the company. They start with a number 2. Owner's equity accounts such as capital and drawing, they're listed third. Then we list out the income statement accounts. Revenues, this is money earned by the company. They start with a 4. And all expense accounts start with a 5. Here's an example of a standard chart of accounts. Here's your balance sheet accounts, assets, liabilities, owner's equity, revenue, and then expenses. Examples of assets would be cash, accounts receivable, supplies, prepaid insurance, land, office equipment. Liabilities are accounts payable, unearned rent. Unearned rent, this is a special account that is held when a customer or client prepays the company for a service that has not yet been rendered. For example, if I tell a client that I'll do their accounting work for them for the next 3 months for $800, however, I require them to pay 50% of that up front and they give me $400, I have to hold the $400 separately as a liability until I actually earn it. Owner's equity accounts, capital, drawing. We have revenue, fees earned. Also understand that revenue is revenue, it's fees earned, it's income, any of those terminologies. Then we have the expense accounts, wage expense, rent expense, utilities, supplies, miscellaneous. Any type of expense account will go here. Now, journal entries in the T account. The first thing you need to understand that a T account is just a brainstorming representation of how a transaction will be treated, and we kind of use this again as a brainstorming session. On the T account, notice that it represents a T. You write the title of the account here. The left side is always going to be the debit side. The credit side is always going to be the right side is always going to be the credit side. Now, every T account will be listed this way. The importance, though, is what does the debit do and what does the credit do for that particular account? So, to understand your debits and credits, which are considered to be your normal balances, we must understand what type of accounts we're dealing with. Again, each account is categorized as an asset, liability, an equity account, revenue, expenses, capital, or drawing. Asset account values are increased with a debit and decreased with a credit. Therefore, they have a normal debit balance because a debit increases it and a credit decreases an asset. Liability accounts are increased with a credit and decreased with a debit. Therefore, they have a credit balance. Revenue and capital are increased with a credit and decreased with a debit. Therefore, they have a credit balance. And expense and drawing accounts are increased with a debit and decreased with a credit. Therefore, they have a normal debit balance. What you must remember is, does the debit increase or does the credit increase a particular account? So, asset accounts, expenses, and drawing are all increased with a debit. Liability, revenue, and capital are all increased with a credit. The normal balance of an account is based on how the account is increased. For example, cash is an asset, and assets are increased by a debit. Cash has a normal debit balance. Let's look at a picture of this because they say a picture is worth 1,000 words. Again, asset accounts are increased with a debit. They have a debit balance. Liability accounts are increased with a credit. They have a credit balance. Owner's equity accounts. The capital account is increased with a credit. It has a credit balance. The drawing account is increased with a debit, and it has a debit balance. Revenue is increased with a credit, and it has a credit balance. And expense accounts are increased with a debit, therefore they have a debit balance. You must memorize this information so you can do your journal entries correctly. Now, let's look at an example of how we would brainstorm a transaction. On January 1st, 2012, a new business owner invests $25,000 of his own money into a bank account for his new job, or for his new company. So we know that the owner invested cash, and we know that when an owner makes an investment, it goes into the capital account. So the company or the owner put $25,000 in cash, so we increase the cash account with a debit. And as a result of that, because we know it was the owner investing the money, we go to the capital account, and we know that capital is increased with a credit, so we credit the capital account for $25,000. We have a debit of $25,000 and a credit of $25,000. So this transaction is considered to be balanced. So now that I've brainstormed how this particular transaction will go, I will now then move to making it an actual journal entry. There are several types of journal entries. We just have a journal entry that we use to record all economic transactions. This is called journalizing. Every transaction that happened has to be journalized, or it did not happen. Adjusting journal entries adjust certain accounts at the end of a period. Correcting journal entries are used to correct erroneous errors. And closing journal entries are used to close the books at the end of the year. Now let's look at how a journal entry is laid out. All journal entries start with a date. We have a description column, a post-reference column, debit, and a credit. The date is when the transaction happened. The description, these are the two accounts that are used for the transaction. There can also be more than two accounts. The post-reference account is to post-reference to other things, and for the journal entry purposes, you will use the number of the account. So for the journal entry, and in the journal, the post-reference is for the number of the account. You will then list your debit and credit. The date is the when. The description is the what and the how. And then you have your debit and credit. So what I want you to remember about journal entries, and this will never fail you, always remember to debit the what and credit the how, or why an event happened. So remember, the date is when. We debit what did the company get or what event happened, and we credit the account that says why or how that particular event happened. So let's take a look at the transaction we just discussed about the owner investing $25,000 in cash. So on January 1st, 2012, a new business owner invests $25,000 of his own money into a bank account for his new company. Earlier, we already understood that we were going to use the cash account and the capital account. So we list the date when the transaction happened, January 1st, 2012. We debit what the company got, and in this particular case, the company got cash of $25,000. Why or how did this particular transaction happen? The why is the owner made the investment, so we apply it to the capital account, and we credit it. Debit cash, credit the capital account. This particular entry is now journalized. Let's take a look at an example of paying an expense. On January 10th, a prorated rent was paid on the office space for the month in the amount of $1,000. So the date is listed. We debit what happened. In this particular case, what happened was the rent got paid. So rent expense is debited for $1,000. And how did we pay for this? We paid for this out of the cash account. So we credit cash for $1,000. Now, we have the journal entries here. This particular journal entry shows the prepaid insurance account. Remember, prepaid insurance is considered to be an asset account. So prepaid insurance is debited for $2,400 and cash is credited for $2,400. paid the premium on a 1-year balance or 1-year policy. These right here, these two accounts showed, are examples of what we consider to be the ledger accounts. Every account has its own ledger. I want you to think of the ledger as its home to land in. So we have the prepaid insurance account and the cash account shown. Whatever happens in the journal has to be recorded in the ledger. So on December 1st, we debited prepaid insurance for $2,400. We credited cash for $2,400. This is on journal page 2. So in prepaid insurance, we're going to put the date, December 1st. Post reference number 2, because this was from journal page number 2. And we're going to list a debit of $2,400. And then we're going to have a running balance in this particular account. Since there are no other transactions in prepaid insurance, we debited the account for $2,400, so it has a balance of $2,400. We're now going to post the cash account transaction that happened in this particular journal. We credited cash for $2,400. We come down to the cash account, and on December 1st, post reference 2, because it's on journal page 2, we credited the cash account for $2,400, bringing the balance now to $3,500. This is the running balance column for every account. If it is a debit account, it runs in the debit balance. If it's a credit account, it runs in the credit balance. The first debit and credit is to record what happened in the journal entry. The second debit and credit is the balance of this account. The importance here is that I need to know what every account is balanced at after every transaction, so I know how much money I have, and in this case we have cash of $3,500, and I know how much money I've paid in prepaid insurance, $2,400.